Ladies and gentlemen, today's conversation is about the education policies, and this is one product that has caused so many people to benefit and others to lose a lot of money. To start saving in education policies is usually very emotional because it is attached to these tiny little adorable creatures called babies. And you see, when it comes to babies, you don't mess with the parents about their child. But then is it okay to continue making mistakes or to get into things that we do not really understand how they operate? And that is why we are here today, and I will be talking about the structure, or rather what is it composed of, how does it work. I'll touch on the types that are available in the Kenyan market at the moment. I will also talk about the good side because they do have a good side. Then I will mention what is hidden behind the terms and conditions. And finally, I will tell you who should stay away from these policies. And of course, I will not leave you without mentioning the alternatives or options that you can start working with if you are part of these people that should avoid these education policies like a plague. If you're new here, we talk about money and investments, where we learn, we share, and we grow together. So our main goal and mission is to break the poverty cycle. This is not to discourage you not to take up an education policy. This is not to make you feel bad about what you've already taken, but it is to have you informed. So let's get started with the structure. The education policies have been designed in a way that they are a pack of two things in one. It makes available money at a point that you decide. Of course, some of them have a fixed timeline, but in most cases, you align it with the education plan of your child. If your intention is to raise money for college or university, or you're raising money for high school, education policies have been designed in a way that they help you accumulate mdogo mdogo, slow by slow, towards that given goal. Most of them actually work with a way that you can actually approximate the kind of school fees that you're expecting and then work backwards to how much should I be saving from this point going forward. And others, you come with a definite amount. You say my available amount is 50,000, 10,000, it is 5,000, whatever amount it is, and I want to know how much will I be able to get. So it helps you to save, that is accumulate mdogo mdogo. And then the second thing, it gives a protection to the savings that you're making. This right here is the definition of what an education policy is. If I have a dream, I want to take my child to the best school ever, if I want them to enjoy the best of the education, if I do not want to struggle when that time comes, between right now and the time to take my child to school, there are several uncertainties in between. Number one possible scenario is that I will be there to take my child to school. I will be there to pay the school fees. The second scenario is that I will be there, but I will be incapacitated, I will be disabled. And then the third scenario is that I might not be there. And whenever we look at an education policies, these are the three things that we consider. So now the product design took into place these three things. If I am there and I'm able to do everything that needs to be done, well and good. I saved myself the burden of raising the full fees. I had time to pay it kidogo kidogo vis-a-vis that person that will wake up that point and feel like it is an emergency. Oh, shule inafunguliwa January, my baby is supposed to go to high school, I do not have anything. So the person that took an education policy got a plan well in advance. And now under the second scenario where I could be there, but for one reason or the other, I am incapacitated. Nilipata accident or something happened to you. So this one was also addressed by the education policies because it had something known as waiver of premium when you are disabled. So upon any form of disability, whether it is temporal or permanent, there is a way that it has been designed that at that point where I became disabled, I'll stop making the premium. So I'll not be required to make any payments because I already covered that aspect, that if by year 2030, I'll be there but not able to work productively because of disability, you will promise to pay school fees to my child ABCD. So this education policy takes care of that. And lastly, the third case scenario is the part whereby you might not be there. People don't like talking about this part a lot, but this is a reality. There are so many kids who've gotten to the point where they need to get to school, but they do not have the parent who was supposed to be paying the school fees, but saizi hayuko. So it is a thing that is there. So whether you want to talk about it or you don't want to talk about it, that is up to you. So these are the three case scenarios. And if this parent is not there at the point that they pass and they had an education policy, this child is guaranteed to get school fees at that particular point. And these two, the disability and the death or the promotion to glory, those two ndio zina come on the side of protection. The part where you save money comes through the savings side. And so as I finish the structure side, I'd like you to know that if, for example, you're paying 10,000, about 7,000 goes to the savings automatically, and the 3,000 pays for everything: administration, the life cover part, which is the riders, both the death and the disability one. So these 30%, it usually varies, by the way, from company to company, but about 30% usually pays for the protection side, and the 70% goes to the savings or investment side. So if I am coming back, I did not die, I did not get disabled, by the time that I come for maturity, what is calculated for me to be given back the money that I was giving them is this 70%, which was going to the savings side of the story. This other one was a service. It's like paying for rent. You do not come back to collect your rent because you're now moving to another house and then say that I've been paying rent for 2 years. So ebu nipigie yo 50,000 for 2 years and give me back my 1.2 million. I want to go. No, that was a service. You enjoyed it. So every month you're paying your premium, you are paying for the service as well. So hiyo inaenda, hiyo 30% inaenda, na ingine savings inabaki. And now let's talk about the types that are available in the market. There are two types, majorly two types, which are available for you to consider. Number one is called a guaranteed version. This one, usually whatever you agree right now, I'll be paying 5,000, and when that time comes, you will give me 60,000 every term or every year. That one we sign, and it is an agreed amount. It does not change. Whether the economy was good or the economy was bad, that is what we agreed. So I'm giving you this, and you give me back these amounts. It's known as a guaranteed plan. The second type is a savings plan known as endowment or unit linked. These are more of savings or investment products which have been camouflaged kidogo with some protection on top of it, but you are not guaranteed what you're going to get at the end of the day. So hii watakwambia things like we are projecting, yeah, it is a projection, so things might be below or above, and you see past performance and things like those. So many stories, they are supposed to give you a projection, but they cannot guarantee even the principal that you're giving them. So for example, we've already talked about the 7K and 3K. 3K ishaenda. The 7K that you're keeping aside, after 10 years, itakuwa umesave about 840,000. So that 840,000, we still cannot guarantee it because it is unit linked. It is an investment. It is invested. And the returns that you get are determined by how did the markets perform. So it could be 1.2 million. It could be 800,000. It could be 900,000. It could be 500,000. So hiyo iko still open. So this one goes to those when you wanapenda high risk, but in most cases you are not given that option to choose. Do you want it to be guaranteed or do you want it to be unit linked, whereby you're given the option to choose according to your risk appetite. But what you should know is that the guaranteed version usually has very kidogo returns, because you see, again, the company is going a long way to promise something that we are going to give you this, and you remember this, they're still going to invest the money either way, but they are willing, we are going to give you maybe like 4% or 3% or 5% or whichever amount that they figure out that we can be able to give you this. So in this case, utapewa tu return very minimal, and then assuming they're giving you like a 3% guaranteed or a 4% guaranteed, whatever comes on top, hiyo ni yao ya kukula, lakini wewe they'll give you that particular time, and vitu zikichoma pia wao ndio watachomeka, lakini they will give you that particular amount that they promised you. But when it comes to this other side, if things do so good, economy booms, you get to get better returns, because if they got 15%, they'll give you 15%. If they got 20, they'll give you 20. If they got 44, and if also they got -10, -5, you still get to enjoy the same negative returns. So these are the differences between the guaranteed option and the unit linked or the endowment plan, but both of them still do have covers, armor protections that we've already spoken about. And at these points, let's talk about the good side of these policies. Of course, I've already mentioned several of them, but quickly, number one, it helps you to accumulate mdogo mdogo towards your goal. You have a big goal. You see, like, it is very expensive because right now, wow, education has just become something else. Hata ukizaa mtoto tu leo leo, you should start thinking about how to save. During our times, tulikuwa tunaenda shule, you get textbooks, the same textbooks that my sister, who's 5 steps ahead of me, used. Alitumia, my brother followed, my other sister followed, and then I used the same ones, and then I still pass them over to the next one. Lakini, well, if someone has not told you how expensive they are, utajionea tu mwenyewe, si ndio? So these education plans will give you that opportunity to save mdogo mdogo. If you've gotten your child today, start thinking about how do I start saving for their education from as early as now. If you're going to depend on loans, utaishi constantly on loans from the point they start going to school mpaka wamalize shule. The second good side of these policies ni the waiver of premium. This usually happens when tuko na disability or death. If any of these things happens, the spouse who's left behind, hata kama ana job, at least you'll be guaranteed at the right time the child will go to school. So what are some of these things hidden behind the terms and conditions? Number one, the fact that the savings side, the one we talked about 7,000 earlier, and the risk side, which is the 3,000 side, when they are merged together, they become a disaster. Number one is something known as surrender value. The first few years of policy, there are few things zenye zokuja in play. In most companies, you have 2 years and some 3 years, whereby if anything happens to you or your income, everything that you have contributed to that particular point, hata kama ni 24 months and then you've contributed to 23 months, inaenda na maji. And most of this makes sense because you see, they take 40 or 50% of your premium and it's paid to the intermediary or the agents. So technically, there's only 50% left. And out of this 50% left, they're supposed to pay rent for their offices, they're supposed to pay their managers, and everything else included up, or including the services, the servers, everything. So technically, all the money is gone. But as the years go on, the commissions that they pay on the policies zinarudi chini kabisa to somewhere like 5% or thereabout. So if you come back after 1 year and you say, I want all my money back, my friend, you're like, forget about it. The next thing is penalties. Penalties do apply, my friend, especially if you are on the guaranteed plan. Remember, you agreed, I'll be contributing X, and my goal is to give you X so that you will give me Y. That contract binds them to give you Y. So if I delay in giving them X, they'll give me a penalty on the X so that it will match with the Y. Because you see, if I give them 3 years later everything else, and all these 3 years that have been lost, how do you expect them to achieve whatever they wanted to give you in the first place? So that is why the penalties do come in place. Most of the times these are not mentioned, so make sure you ask your agent or intermediary whenever they're talking about the product. Let them tell you about the downsides of the product as well. The next thing is something called as lapsing. There's a point at which if you do not make your payments, your policy could lapse. Lapsing means it dies, like imeisha, imekuwa inactive, imetolewa, like just like that. So wakati imelapse, there are 2 things that can happen. Either pesa yote imeenda, or a portion of the money goes depending to the point at which the policy ilikuwa imefikia. So those are some of the 3 things that you really need to know. They are secret, and most of the time they don't mention them. At that point, they are telling you about, oh, Sally this, oh, Jaden that, oh, CG what. Your head is not thinking about what could be the penalties, what could be the surrender value issue, what if I lost my job, what if I'm no longer able to pay, can I get my money back? Hizo msahii ufikiri, unafikiria tu, my child, I want them to go to Cambridge University, I want them to, I don't know, become what, my child say they want to become a pilot, and you think about those things right at that particular point, you don't think about the logic side. So these are the questions that you need to ask about. If you've already signed, mpigie simu muulize, but they tell me about this. If you're yet to, ask these questions or consider the alternatives. So who should not take this policy? There are 2 types of persons that I feel like should strongly stay away from these products. If you fall under any of these categories, you need to consider another alternative plan. Number one, if you are not in a stable source of income kind of job, if your job does not give you a stable income, leo iko huku, kesho parababa, and this could also be a business. Like if your business is not stable, you do not have a stable income, like generally you know what I mean, stay away from these products, because hii ndio ile part yenye utakuwa unachelewa kulipa your premium and then you'll be penalized. Or unaweza jipata position yenye umeshindwa kulipa kabisa and then the policy dies or lapses and you lose all your money and the time that you could have made steps in the right direction. The number two kind of person ni someone who's in contractual payments, contractual agreements, like you are in a contract, a 2-year contract, a 3-year contract, a 1-year contract. Those people maze, usieke emotions mbele, make decisions soberly, because you see utafikiria tu Jaden, sijui Chanel, sijui Ethan, and the problem will be that your contract might not be renewed. It might have been renewed for the last 2 years, 4 years, 5 years, but then this time round ikikosa kukua renewed, what happens? So I've seen this from experience over the last like 10 years, people getting to a place whereby their contract got issues, it never got renewed, terms changed in the next pay, so you're not able to meet your needs and then take care of this side of saving some insurance, because anytime that you face a challenge, first things that you get rid of among them ni insurance policies, and then you want your money back, you're so desperate, if you're taking it back, you get penalized, you lose most of it. So these are the two types of persons who should really try and stay away from these products. Before I go to wind up, do not be fooled. Even if your job is very stable, even if you have a good source of income, even if you're guaranteed you're permanent and pensionable, there's one thing that you need to make sure you do. Have an emergency fund. Like my friend, make sure that you have 6 months to 1 year worth of money in your emergency fund, because anything happens, even if you're permanent and pensionable, something could happen and throw you out of balance completely. So having an emergency fund will help you to pay premiums while you're looking for the next job, or to pay premiums while you're looking for another source of income. So make sure you have some money in a money market fund or somewhere else where you can have it liquid. And now finally, what should you do if you are in the don't take this category? What are the options which are on the table? Number one, the same things that we spoke about, the same things which have been combined and brought together, which is the risk side, the protection side, and the saving side. These are still the same things when you're planning for the education of your child. These are the same things that you need to consider, put in the basket. So what you're going to do is isolate these two. Take away the protection side and take away the saving side. Put them in different baskets. Let's talk about the saving side first. Take these savings and put it in a low risk kind of plan. Whether it is a fixed income fund or a money market fund, put it somewhere, lock it if you have to. If you have discipline issues, put it in a lock account, but put it in either a fixed income fund or a money market fund. Most of these companies now have a lock whereby the money that you put in, you cannot get it out. But the beauty of it is that you will maintain the principal. If anything happens, 70% in the maker on this side will be there. If I come to a bad emergency, this amount will still be there. Now, when we talk about the protection side, this is where you need to get a pure risk product. Make arrangements to have a pure risk product which covers you on disability and death. Most of them are very cheap. That 3,000 that they already cut wakaiweka kwa hiyo risk, and the 7,000 they put this side, your 3,000 can still buy you these two, and you will even get a better cover. So this cover will be running independently. If I run into problems, this is the only part which is a service. Hii tu ndio inatoka. But this part which was a savings still remains and keeps growing strong. I will leave a link to a book where I explain all these in the description below. I believe this will help you in making the correct decision when it comes to planning for your child's education. And this also touches on the savings plans that you have towards your given goals. Let us hear what is it that you guys are doing so that wengine pia wata-learn from this. But I encourage you to check out this other video over here because itakupatia pia some good insight on what you can do differently to achieve your goals. If you're yet to subscribe, If you're yet to like, please take that moment, subscribe and like, and I can't wait to see you in the next video.